second edition of our Endowus Investment Summit. For those of you who don't know me yet, my name is Steffanie, and I head up Endowus' business in Hong Kong. So it's great to see many clients and not yet clients, soon to be clients, to be joining us today. As I was preparing this panel, a few weeks or months ago, I was wondering, fixed income always, relatively speaking, seems to be not as exciting as equities or alternatives. And I was thinking how to juice it up. But overnight, I would argue, actually, the bond markets is now the most important market in the world because our President Trump seems to have not cared about equities market, whether it's the S&P, whether it's NASDAQ. But overnight, he seems to really care that there was a bit of a rout in the bond market, and definitely was one of the factors that he cited that he decided to pull the plug to announce the 90-day pause on the tariffs. So I would argue this is arguably the most important panel for today. But I know some of you guys have been sitting for a while, so to kick off, I would ask maybe we can flash the Slido QR code again, or you guys can enter slido.com and enter the hashtag EIS 2025, and we will do a poll. And I have two questions for you. One is, when do you expect, where do you expect the Fed fund rates to land at the end of the year? And it would be very interesting if we could compare your expectation last night over today, but we'll see the result today. And the second is, we were doing a poll earlier at the start of the conference to ask about what do you think is the most interesting, attractive asset class? And I would also like to ask, within fixed income, what do you think is the most attractive sub-asset class? So while you guys think about these questions, I will then pass on the mics to my panelists to just introduce themselves, your firm, and maybe a little bit about your background and your role.
Sure.
So, Karan.
Thank you very much, Steffanie. Great to be here. Exciting to say the least. I think the days of fixed income being boring are long gone. So just by background, my name is Karan Talwar. I work at Barings, and I represent our public fixed income offerings within the Asia-Pacific region. So just a brief background on Barings. We've been involved in the credit space for over 4 decades. Over 3/4 of our total assets under management are in some form of credit, so public or private credit. And as a firm, we are wholly owned by MassMutual, so one of the very large US life insurance companies. So credit and fixed income investing is very much sort of within our DNA. I know there's a lot of esteemed colleagues on the panel today. The sort of investment approach that we typically take is quite bottom-up, fundamental-oriented in terms of trying to find that alpha within credit markets, and I'm sure we'll get into that later in the day. Thank you.
Great. My name is Sriram, Reddy, and I represent Man Group. I am the head of client portfolio management across our discretionary credit strategies. So many of you will have heard of Man Group, but you'll probably associate it more with our successful CTA franchise, AHL. But many of you won't know that we have a very strong and growing credit franchise, which is where I represent. That franchise has grown to over 35 billion and represents a much larger and growing share of the overall firm, which is around 160 billion. The firm is a UK-listed firm, roots back for many years, and it's largely grown through acquisition. And the legacy of our discretionary business, comes through the GLG franchise. Within GLG and within our discretionary business, I think what we try to really focus in terms of our strategies, again, similarly, a relentless focus on bottom-up investing. So in an environment like this, try to avoid some of the headlines, avoid the news, just focus on fundamentals. And then it's really an unconstrained focus on alpha, not asset gathering. So all of our strategies are capacity constrained, really focused on trying to just deliver the best alpha for our clients.
Hi, this is Jingjing, credit product strategist from PIMCO. I'm based in the Hong Kong office. I've been with PIMCO for 6 years. So PIMCO is the largest active fixed income manager with an asset under management of over $2 trillion US. And across our products spectrum, we manage both for the public and the private assets, predominantly in the fixed income market, but also we have private credit, real estate, and multi-asset strategies. Thank you.
Yeah, so my name is Francis Huang, Managing Director from UBP Asset Management. So I'm responsible for distributing the UBPAM products in the region. So today is, I've been with UBP Asset Management for 5 years. Prior to that, I've been spending like 8 years with GAM Asset Management. So thank you, Steph, for having me today. I think it's a very interesting and opportune time to talk about the market then. Thank you.
Thank you. So I'm very happy to we have a panelist of very esteemed and experienced fixed income professionals. So feel free to scan the QR code and ask them very tough questions that you have. But before I dive into our question discussion, maybe I'll just reveal the answer so that the panelists can get a pulse on where the audience is. So the first question, it seems like audience think the Fed is likely to not do massive cuts, but maybe like a 50 basis point cut to maybe 3.75 to 4% range by the end of the year. And interestingly, the most attractive asset class by the audience, they're looking at investment-grade bonds. So interesting. And why don't we then dive into the discussion? I want to pass the first question to Jingjing and Sriram, and to just kind of recap kind of where we are at the moment for credit markets. Jingjing, you're based out here, maybe more from Asian investors' perspective. What are you seeing? And I'm sure you might have changed your notes overnight. And Sriram, maybe from a European perspective, what are you seeing and hearing from European investors when it comes to credit investing? I'll start with Jingjing first.
Yeah, sure. As you probably noticed over the last few days, the market has really moved up and down and up again. But if you were here when I was doing my 1-minute challenge, I think that trend is really what we're observing over the last few months, which is trying to capture the attractive all-in yield that's provided by the fixed income market. So again, with the yield at the past 10 years peak levels, we are seeing both the institutional investors and the wealth management investors moving from what they put originally with cash assets to the fixed income market, trying to lock in a longer term, more attractive all-in yield with the high quality bonds market. I hope your answer at the polling question was partially influenced by my pitch, but yes, that's what we are seeing as a broad trend. And that is because the bond market can provide that level of defensiveness, stability, and the overall, the lower volatility experience when you invest. But if you look at the valuation of the credit market, generic credit spread, we have to admit, is not that cheap. Although at some point over the last few days, it widened and then it tightened again. Year to date, it's still wider than what you have at the beginning of the year. So what we want to focus a lot on is to focus on the relative value, because with an average relatively tight credit spread, you want to be even more active and find the dispersion. And behind that average credit spread, the dispersion between the most expensive and the cheapest names are actually even more dispersed than before. So that really presents a lot of opportunities for investors like us. So what we are seeing as more attractive segments right now, one is the agency MBS markets versus generic credit. And then within the credit market, we focus a lot on the defensive sectors like aerospace, defense, pipelines, and also the more utilities sectors.
Thanks, Jingjing. Sure.
Sure. So we see similar things in terms of this tug of war between yields and spreads. Really since the interest rate rises in 2022, we felt that yields and credit remain quite attractive. So in public fixed income, in credit, I could build a portfolio and generate a yield of between 7 and 10%. On a historic basis, that remains incredibly attractive. You can get that, through daily liquidity. You can get that, a very broadly diversified portfolio. But we agree when you unpick the level of that yield, a lot of it's coming from just the risk-free rate. The level of spreads, the compensation you're getting for default risk was at an all-time low. And I think the anomaly that we really found was, this idea of U.S. exceptionalism is really being challenged right now. And, when you looked at credit spreads, immediately post the election in November, the U.S. investment grade credit market hit an all-time low in terms of spreads, almost over a 30-year basis. And again, fundamentals are good. There's a rationale for why that's the case. But when you have limited additional credit spread, I would say compression potential, that makes us much more cautious. So, going into what was happening in the market, we had felt that, it would be better to tilt a little bit more to the European market. And what's interesting is that whenever I talk to clients, whether it's Europe, Asia, and the US, everybody tells me, why would you invest in Europe? Why would you invest in the UK? There's so many problems, lack of energy independence, closer, proximity to geopolitical conflicts, problems politically, slower growth, slower productivity. And actually, in a way, that's one of the reasons why we invest in those markets, because those are realized risks. They're noted by the marketplace, and they're reflected in credit spreads. So if you think about the European high yield market as an example, it's traded at a much wider spread than the US market. And so that's why we've tilted almost all of our portfolios to the European market, because as a credit investor, I think the one thing that you'll need to be aware of is that, yes, US growth may be better. You could be in a period of US exceptionalism, but as a credit investor, the best case scenario, I get my coupon and I get my principal. If I choose a great company, they're not going to pay me 2x my principal. I can look jealously at our equity colleagues who might have, 2 or 3 baggers on the equity side, but my best case is just that principal and coupon. So when spreads are tight, you're more exposed to a downside. And so again, just mathematically, we felt it was better to focus on opportunities in the European market. Now, I think, post the last couple of days, and this is the part of my presentation that keeps on changing, but I do think that valuations are getting better, but they're by no means cheap. And while I don't want to disagree with the audience, I do think it might be a little bit too soon to jump in with both feet into the investment grade market. Spreads have moved a little bit, but they're still below median levels over a longer period of time. We've definitely seen more of that recession being priced into high yield and emerging market corporate bonds. But I agree with our other panelists, it's not really the time to buy the entire market. There is more dispersion intra-sector, intra-country, intra-region, intra-capital structure, and that's really where we're focusing our attention. Where's the dislocation, and where can we harvest the best margin of safety where the underlying fundamentals are not being priced correctly in the market?
Thank you. So if I were to summarize, I think it's very interesting that probably similar summaries from the equities panel that in times of volatility, there is active opportunities to be captured in the fixed income market. And you should also diversify. I think the US market tend to be the largest and most liquid. You get a lot of investors' attention. And even in fixed income, maybe you can also consider diversifying. So thanks for the sharing of kind of where the state of the market is. We continuously said we should not be forecasting, but as we look ahead, maybe we'll ask the panelists any kind of pointers and guidance. How do we go from here, right? Maybe I'll pass the next question to Karan and Francis, right? We saw the audience think we probably might have a mild cut, but we were asking on the US. We tend to be very focused on the US, but maybe more on a global scale. How are we seeing rates, whether there's rates divergence with rest of the world? And in terms of a lot of times, clients are interested in fixed income because of the argument of the sort of complementary nature of equities and fixed income. But I think in the past couple years, and I've always heard some clients come to me and said, Steph, I feel like the correlation of public equities and public fixed income seems to be quite correlated these days. How would you answer queries from clients whether fixed income continue to be a good diversifier in clients' portfolio? Maybe I'll pass it to Karan first.
Sure. So I think a lot has changed in the last few years as well. So historically, we've had this very strong correlation, and there's been a very strong case for a 60-40 or balanced portfolio. And that really broke down in 2022. Now, the environment in 2022 was very different, where bond yields were starting at ultra-low levels. We were having this massive inflationary influx because of all the aftermath of COVID and a lot of fiscal spending. And so inflation was reaching double digits, and central banks, as a result, had to hike rates very aggressively. And so that was a very challenging environment for all financial markets. And you had your traditional core fixed income that's very interest rate sensitive selling off at the same time that credit spreads were widening and equities were selling off. I think that paradigm has now reverted quite a bit. We've seen a reasonable amount of normalization taking place. If you're looking at where bond yield levels are today, and you can look at this in different metrics, you can look at real yields, there's enough room today for central banks to cut rates if things were to get weaker. And we can all sort of argue on tariffs and things like that, but generally speaking, all of this is in the long run going to likely have a slowing growth impact. And so I think that it just gives central banks a lot more room to cut rates, and that makes a compelling case to have fixed income in your overall portfolios. Now, I think to your point, Steffanie, there's quite a lot of volatility here as well, and there's different ways and nuances in which you can sort of play it within the fixed income markets as well. So if we're, for example, comparing the US and the US position today, they're coming from an environment where, again, with all the tariffs being imposed, you can't necessarily substitute exports from one region to the other as easily. There's likely going to be more of an inflationary impulse in that region. At the same time, if you're looking at the overall hard data that's coming in right now, whether it's employment data, whether it's sort of any real economy data, so far that's still holding up well. And so central banks there, at least our view is that they're going to try to take a more cautious stance, not front-run rates too much, and really wait for the economy to turn before they start sort of necessarily cutting rates aggressively. So the panelists, I think the audience sort of gave that sort of maybe that two rate cuts, maybe that's prolonged later in the year. I think that's probably where we would be leaning towards. But again, it's a big market, right? Europe is in a very different position. If you look at China or Australia, some of the economies there have a lot more fiscal room, or they have the ability to sort of cut rates because they are in a more disinflationary sort of environment. And so I think, again, by having a global portfolio, incorporating credit and duration into your allocations, you can still generate very attractive yields.
Yeah, Steph, I think for us, our so-called base case scenario is that we thought that the US is going to slow down to the trend potential then. And I think it's good to see the relief rally overnight then, so with the tariff pause, and also the US is sort of buried the hatchet with the rest of the world except China. So our view is that if the tit for tat sort of situation between the U.S. and China can improve somewhat, and also that there's a change of course in terms of the between the two administration, we do envisage that we could avoid a recession here. But one thing is important. I just want to take note is that I think it's even if the economy is going to worsen substantially from here, then I think it's important to keep in mind that the Fed has a lot of dry powder that they can ease policy if required then to alleviate so-called the growth concern then. So you have seen like a couple of days ago, like Mary Daly, who is the San Francisco Fed governor, she came out saying that she's quite happy with the status quo. So the cut will be quite gradual because given the stickiness of the inflation. And I think, but the thing is important is that I think the Fed, if the push come to shove, then if they want to act, they can act quickly. So I think this is important then. And then the points that I just want to highlight, just want to dial into the high yield market then. So if you look at the high yield market, what we observed is like, the asset qualities has actually improved over the years then. So for instance, if you look at the double Bs then, so the double Bs, the weighting of the double Bs is now accounting for more than 50% of the high yield market then. So as you know that, double Bs are rarely defaults then. And the other thing, if you look at on the other hand, then if you look at the lesser quality companies then, if they want to, they're more keen to go into the private market to raise funding then. So with that sort of dynamics, that what we can see that in the post-COVID era, you see the default rates, they're quite benign and muted then. So I think in this sort of like, volatile market, then I thought would be, just want to, for the audience, I think it's important just to maybe talk about something more tangible. So I will emphasize on the all-in yield in the global high yield market then. So for instance, if you look at the strategy that we work with Endowus, which is called the UBAM, Global High Yield Extended Duration. So if you look at our components and the return components, there are three components there. One is the rate, the other one is the spread, and the third one is the roll yield then. So if I just want to take a second to explain about the roll yield then, because it's quite unique to our strategies then. So the way that we invest in global high yield is quite different from other asset managers. Then we don't do any cash bond there, so you invest through CDS indices then because of better liquidity then. So what we actually do, Steph, is like every 6 months then we will roll the entire portfolio into the new 5-year CDS index then. So we do it twice a year, every March, every September. By doing that, it enables us to capture like an additional roll yield anywhere from 1.5 to 1.7% on an annual basis then. So if you put the three things together, the rate, the spread, and the roll yield for our strategy, so right now we're giving you a level of about 9.5%. It was like 9.8% before the pause announcement then. So if you look at historically, our, the yield, the range of our yield of our strategy is somewhere between 5.5% and 11%. So now the yield is at about 9.5%. So it's still at the upper end of the range then. So I would argue, from a valuation, from the all-in yield perspective, I think the valuation is still quite compelling then.
Since we're on the topic of high yield, can I pass the question to Karan, right? For Barings, you're more a top-down manager, quite different from Francis, right? I think a lot of us are now a bit concerned about recession. How should we think about high yield? I think that's also the reason why high yield was not favored in our polls.
Yes, so I mean, obviously a lot's gone on in the markets the last few days. Again, if I take a step back, for the last 2 years, the number one question or comment I've gotten from every client or prospect has been, spreads are tight, spreads are tight, spreads are tight. Well, spreads have actually repriced quite significantly. If you're looking at sort of the high yield markets today, you are at spreads of around 450 basis points, give or take. I haven't checked my phone in the last 6 minutes, so it might have changed since then. But if you just take a step back, on Feb 18th, it was around 275 basis points. So there has been quite a significant amount of repricing. And I think going to Francis's point on the all-in yield, that's a really sort of key indicator. At sort of today's levels, we're almost close to sort of 9% all-in yields. That's a level, that's a starting level where you need to see an extraordinary amount of bad things happen to realize losses on a 12-month forward basis as you're accumulating that coupon and that carry in the portfolio. So that's an extremely compelling starting point. Now, I think just in terms of the market construct as well, so our emphasis is quite fundamental and sort of bottom-up oriented in terms of our analysis that we do. So we're not doing it systematically. We're doing it by having large analyst teams looking into which sectors and which companies we want to sort of invest in. We think that's very sort of prescient in this market environment where there's lots of uncertainty. But just looking at, I think, just reiterating that market on a top-down basis, if you look at the sort of credit quality or the fundamental profile of high-yield companies, and particularly high-yield bonds, it's very different to what you see elsewhere in the sort of financial markets. And this is really sort of going off the evolution that we've seen since the global financial crisis in 2008 with the growth of private credit and different sort of financing channels. The high-yield bond market today is predominantly a BB oriented market. So it's a much higher quality market. If you're looking at the US markets, for example, 2/3 of the market that you're lending to is large, publicly listed companies. A lot of the sort of lending into the smaller mid-cap space has moved to either the loan markets or the private credit markets. And so just from a fundamental standpoint, the resiliency that you see in companies today is very different to when you compare it to sort of 10, 15, 20 years ago. And so I think it's just important to sort of keep some of these characteristics in mind when you're just taking a spread comparison, looking at it today, comparing it on average to what it was 15, 20 years ago, and then coming out with an assessment of whether it's rich or expensive. So I think from our standpoint, it's uncertain. Of course, things are very uncertain. Oftentimes, those are the best entry points. Am I calling that this is the right time to do it? That's very hard to say with certainty. But if you're starting with sort of yields close to sort of 8, 9%, in the last 20 years, the only time you've really suffered losses on a forward 1-year basis was during the global financial crisis era, because there you really were in a protracted recession and the recovery took a long time. So, that I'd leave the audience with maybe that.
Thanks. We talked about the US, we talked about Europe. Maybe we will talk about closer to home about Asia. Maybe I'll pass the mic to Jingjing to comment about broader Asian credit opportunities. I think while on the topic of high yield, I think Asian high yield was particularly great last year as I know things change very rapidly. In terms of the Asian landscape, how would you think, where are the opportunities for our investors here?
Yeah, sure, Steph. So if you look at the 2024 returns of the Asia credit market, all grades, like IG plus high yield, the return was close to 6%, and Asia high yield returned more than 15%. So what's been driving that return within Asia high yield? One is the more frontier sovereign names that was in distress. For example, Pakistan and Sri Lanka, they were able to secure the funding and improved in terms of the situation. So that really rallied strongly. And then the second part was the high beta corporate names in Asia, and particularly the China property names, which also rebounded given much better sentiment and also more hope for better policies to come out. We did see that recovery signs coming back bit by bit, and that really helped the market sentiment. So that is really what happened last year and continuing the momentum this year. And we also saw over the last few days that the volatility also drive these markets. But overall, we do think that also creates some opportunities. So for example, where we have more convictions to add more when credit spread widened in India renewables. That's a regulated sector that has very predictable contracts and cash flows. And another example being India's non-bank financials. All these are more domestically focused sectors. And also, if you think about allocating within Asia, IG or high yield, if I ask you the question, do you think Asia's IG companies are more exposed to tariffs or high yield companies? The answer is IG is more exposed, whereas the high yield names are relatively much less exposed to the tariffs exposure. And Goldman Sachs just published their research. They looked into 73 companies within the Asia high yield space, and 72 out of the 73 companies had minimal direct financial impact from the new tariff announcements. So that's where we think when the market is fearful, that's where we are going to look for more opportunities for our investors.
Thanks, Jingjing. Now I want to go back to Sriram. A little bit of a plug. I also first knew Man Group from more on your hedge fund business. So as I was very excited to see we're the first Asian wealth platform onboarding your credit strategies, I did some research and I realized Man Group's credit platform has a slightly different approach compared to other managers that we've come across, that you tend to focus a little bit more on looking for alpha, investing in companies that are under research. Maybe could I ask you to share a little bit about kind of for Man Group, your investment philosophy, and in these kind of markets, how do you look for these kind of alpha opportunities?
Great, and it's fantastic to partner with Endowus and to be able to speak here as well. But I think three things that I would really highlight in terms of what we're trying to accomplish within our credit strategies. First, we're very opportunistic about where we're looking for value. So that can be anywhere on a global basis. If it's in Europe, we're very happy to transact there. If it's in the US, Asia, etc., we're very valuation focused. And that is in stark contrast to how a benchmark is constructed. By how they're constructed, they're always constructed by market capitalization. In the US, by default, is going to be the largest part of that benchmark. But it's not always the best part in terms of evaluation format. So if the US offers value, we will go there. If it doesn't, we will wholly leave that part of the market. So that unconstrained nature is something that pervades all of our strategies. The second, and I think a few of us have talked about this bottom-up approach, and what does that really mean in practice? I think particularly in an environment like today, it's very easy to be influenced by headlines. You see the headlines in the FT, you should never invest in certain sectors, et cetera. And that's not always the case. And I think when you have more of a bottom-up focus, you can orient yourselves around valuations. You can orient yourselves around math. And as an example, I think many of us can agree that, there are certain sectors like autos that are challenged. The competition from China, the lack of demand from consumers, the lack of adoption of EVs. But you can be anchored in that view for a long period of time. At what point do you close that view? For us, we don't like autos because the valuations are not reflective of a weakening fundamental picture. But at some point, the valuation will become attractive. So again, we'll lead ourselves, we'll allow ourselves to be dictated by where valuations take us. And I think that leads to a differentiated outcome than somebody who may be a little bit more focused on what the next headline is. And then the third component is that, again, we tend to be a little bit more opportunistic, particularly when there are times of volatility, because we trust that bottom-up research. So a couple of examples. In 2022, when we launched one of our strategies, we started with roughly around 35% in European real estate exposure. I couldn't find anybody who really wanted to invest in real estate in the summer of 2022. There were some bankruptcies going on in Europe. There were more pressures in that higher rate environment. It turned out to be a great trade for the portfolio, but it's really based on that conviction of the research that we had. Post-Credit Suisse being bailed out, banking became a 35% position within our portfolio, starting with AT1s, then moving to lower tier 2s and seniors. So again, going into where there is more volatility, we tend to find that there are good opportunities. And even now, right now we're finding great opportunities just this week. So we've been seeing AT1s that have been sold at very attractive levels. That's been an area for us to look at in the portfolio. Healthcare, which has historically been an area that's seen as more defensive. There are some high yield bonds in the healthcare space that are now trading at 12, 13, 14% yields. So again, you can't do that unless you have the confidence of the bottom-up research, the confidence that you're going to be repaid back your principal, you're going to be repaid back your coupon. So I think what I would leave you is that we operate very simply. Again, if we're comfortable with the research, we will then act very aggressively within the portfolio. And I think for us, what's really interesting about credit is it's probably the one asset class where on the day that I invest in this bond, I know what my total return is going to be. So again, that yield to worst gives me confidence that I will receive this so long as I get that coupon in principal. So again, if you do your work, you can really deliver different outcomes, and that's what we're really striving to do.
Thank you. As we move on to the next couple of minutes, I actually am getting quite a few questions from the audience. And speaking about not listening to headlines, I think people are still quite interested to learn the latest happenings of the credit markets. I think in the very first panel, Joel kind of alluded to this. We saw some dislocation in the credit markets in the past few days. And I think Joel's comment as a fixed income investor for decades, he doesn't think there's systematic risk. I think there are a few questions asking, is there systematic risk with what's happening in the treasury markets in the past few days? I think we've heard some panelists saying there are still tools the Fed and the central banks can do, but maybe any panelists want to comment the state of kind of where treasury markets are at the moment? Any systematic risk that we should be concerned about?
I can kick off. So I don't think that's the case. I mean, there were lots of concerns around even demand for treasury yields. I think there was a 10-year auction yesterday that was actually quite oversubscribed, which did provide a little bit of comfort. Then, of course, another headline came and nobody cared about that. I think if you just take a step back, if you look at the times when, and Donald Trump's sort of comment yesterday kind of, even he made the comment, the bond market is tricky. So you can just see the emphasis that debt and financing markets have, because it is the plugging system for the entire financial system. But when you look at periods in the past when issues did start to bubble up, whether it was the regional banking crisis where there were challenges, whether it was even in the UK Liz Truss government issues, there are lots of tools available to central banks to come in and step in and provide that financing and support in many different ways. And I think the other point I would also just make is, just from an investment allocation standpoint as well, people have been sitting on cash for quite a long period of time. People haven't been overextended in credit investments in particular as well. So we haven't necessarily seen that same level of unwinding, delevering of sort of funds and positions that we might have seen in previous cycles where there was lots of overextended allocations to credit.
Got it. Maybe we'll switch gears a bit. I saw this really interesting question, again, echoing to the first panel. One of the secular trends we said was digital transformation. So I saw this really interesting question. In fixed income investing, I think we tend to focus a lot on equities investing using AI and technology to help investors become better investors. How about in the realm of fixed income investing? Any of our panelists, your firms here, leveraging a lot of investment into technology to help you become a better fixed income investor?
Maybe I can start. We do embrace the whole trend of AI. We were actually, as PIMCO, we are one of the test users for OpenAI several years ago, before even I heard about what's OpenAI. Overall, we are using more of the technology to do like natural language processing and help us look at or analyze the transcript of earnings calls of the investor meetings, and it also helps us to be more efficient in terms of formulating our investment views. And also internally, we have our own AI tool, which is called Vera. So we can feel free to use it for any like operational daily questions that can help us streamline the work process.
Interesting. I think we only have 1 minute left. I will pick one more question, more traditional one. I think, again, people are still thinking, okay, if I want to dive back into the credit markets, if I want to kind of thinking the equities market's too volatile, what's the perspective on duration? Anyone want to take on this?
I can sort of kick off. I think at least our preference would be not to be overextended. There is still a potential for yield curves to steepen. So even if you see the front end rallying a lot, even if the Fed, for example, cuts rates very aggressively, there can be concerns that longer term inflation expectations can get unanchored. And so even in the last few days, through all the headlines, at some point you did start seeing the yield curve steepening quite a bit. So I think that's something maybe investors should be careful about. You might want duration, but you necessarily need to be overextended buying the 10, 30-year point of the curve, or being a bit more on the front end. Maybe I think the comment was made on different markets like Europe, and a few different regions might offer some respite as well.
Francis?
I think that I think that if you look at it, so I just do like a scenario analysis, if I may. Then, so it's one of the many scenarios. I thought that could be a possible one. Then, so if I want to go back to the all-in yield, that is, I think it's important. Then, so let's say you, for ease of calculation, so you look at the all-in yield right now, it's like about 9%. So let's say if we are wrong, then so the risk-off market. So let's say the spread widened 200 basis points, assuming like a 4-year duration. So you lose about 8% there. But then you see the rates, that will tighten, let's say 100 basis points. So you see like a 4% rally there. So net, you are losing about 4% there. But then if you look at you are gaining an additional spread, about 1% there. So your all-in yield is rise from what, 9% to 10% then. So you're taking the 4% loss into consideration. Then your net return is somewhere in 6%, meaning that you're still doing better than investment grade. And of course, it's one of the many scenarios. But I just want to go back into, my previous comment is about the all-in yields at a very elevated level. So hopefully, you look at the high yield market, this could prove to be an interesting entry point.
Thank you. So that's all the time we have. To wrap up, I think we mentioned this at the start. In light of volatile markets, we have active managers to help you pick up opportunities. And if you have questions on duration, you can also leverage your active managers to help you manage duration. So thank you, my panelists, and we'll give them a round of applause and we'll end this panel.